Advanta IRA is a self-directed IRA administrator. We're a third-party administrator for retirement accounts that hold private investments. And so what that means is that we basically handle the record keeping, or we're your IRA assistant. So we assist you in money in and out of your account, making investments, help you make contributions, and do your IRS reporting. But we don't actually sell anything at all. So our clients are bringing us their investment. We hold the account, we help them make the investment in the name of the IRA, and then we do the record keeping for that asset and the IRS reporting. Like I said, Advanta's been doing this for 20 years. We are in the Tampa Bay area of Florida, but we can help anybody anywhere. We also have another office in Atlanta, Georgia, but our clients are nationwide and even worldwide. And so if you have a US-based retirement account, we can help you with those investments that you would like to make that are outside of the market. This is not an all or nothing strategy. You can move over just what you want to self-direct, and we can assist you with those investments, and again, do the record keeping. We have $2 billion in assets under management, and all of our clients receive a client account manager, a dedicated account manager that's assisting them with every aspect of their account. I think that's really what makes us stand out from our competitors. Something that we don't do is give legal, tax, or investment advice, and you'll see as we go through the webinar, I'll point out some very specific times where you'll want to speak with your CPA. But if you have additional tax questions, please let me know, and if I can't answer them, so for example, I can answer questions on what are the annual contribution limits for 2023 and when was the deadline to make 2022 contributions. But if you have more specific questions, I'm going to direct you back to your CPA. If you have investment questions, I might direct you to your advisor or your legal team. And if you don't have somebody that can assist you, we may be able to direct you to professionals that have helped our clients in the past. Here's some takeaway points for you. I know this is going to be sort of what I would consider an advanced strategy. And so just keeping in mind that there are many ways to contribute to a tax retirement plan for tax-free growth. And actually with the Secure Act 2.0, with which I'm only going to touch on today, but more ways were added. So that's really great. I think it gives people more access to tax-free growth at retirement. Contributions to a Roth IRA have an income limit, so depending on your modified adjusted gross income, you may not be able to contribute directly to a Roth IRA, but there's still ways to get money into a Roth IRA account. And it's also important to understand when contributions are allowed and the steps to take in order to make them. So again, having earned income, so that's going to be very important. Having earned income is what is going to allow you to make contributions to a Roth IRA or to a 401k or to utilize these strategies that we're going to talk about. Here are the 2023 contributions to retirement accounts. And at this point, it is still possible to make some employer-based contributions to employer plans. I'm not really going to talk about that today, but just know that it is still possible to make some 2022 contributions if you have an employer-based plan. We're going to talk very largely about 401ks today, and there is the possibility to still make your employer contribution to your 401k up until your tax filing for your business plus extension, so into October of 2023 for 2022 contributions. But we're really going to focus today on traditional and Roth IRAs, and then again on solo 401ks. But I wanted to include all the limits in case you're looking at an employer-based plan or a health savings account or even an education savings account, so you can see what the contribution limits are for 2023. So you can see here on Roth and traditional IRAs that the contribution limits have gone up for 2023 to $6,500 or $7,500 if you're over the age of 50. And then for your solo 401k, $22,500, and the catch-up limit went up to $7,500, and then the overall limit is $66,000 or $73,500 if you're over the age of 50, and that's going to be important to the strategy that we're talking about today. So I mentioned very briefly that the Secure Act has made some changes, and it is going to allow access for more people to obtain tax-free growth of their retirement account. I think that's really important. This webinar is going to focus on solo 401ks, and I think as we get more clarification for SEP and simple IRAs and how those contributions can be made and what plans will offer them, we'll probably do a webinar on that. But for now, it's just important to note that SEPs and simple plans now have the potential to offer Roth contributions. The plan itself is going to have to allow those Roth contributions, so that's going to be very specific to your plan. Your 401k will also have the ability to offer employer contributions that are considered Roth. So again, I think more and more in the future, we're going to see this stuff allowed as changes to plans are made. Currently, if you have an Advanta solo 401k, SEP, or simple IRA, the Roth contributions are not included. You can reach out to me separately if you'd like to learn more. And again, as we get more clarification on how these contributions can be made, we'll probably have updates for you. The other update that was made is that required minimum distributions are not required on the Roth portion of your 401k. So if you have a 401k that allows Roth contributions, you have Roth money in your 401k. Previously, you were required to still take a minimum distribution from that plan. And now with the Secure Act, again, making changes, you no longer have to take required minimum distributions from that plan. And just as a note here, and why we're talking about this, is Roth designated retirement money goes into the retirement account after tax, and it grows tax-free. And that's what is so important and what we're talking about today, because a lot of times when people make contributions to employer plans, they're going to be considered pre-tax. And even with the changes in the Secure Act, it's probably going to be a little while before we're seeing plans largely or at large allow contributions that are Roth and see people making them. Our 401k plan, for example, has allowed Roth contributions for probably as long as I can remember, but not as many people take advantage of making that after-tax Roth contribution and having tax-free growth. And so we're going to focus on that today and how that's done and what the tax implications are for you there. So what is a backdoor Roth IRA? Well, there are income limits, and I'm going to show you the table with the income limits on making contributions to a Roth IRA. So first of all, let's start with a Roth IRA. A Roth IRA is a retirement account where you make contributions that are considered after tax and grow tax-free. Two things have to be true for your Roth IRA to be tax-free. One, it has to have aged for 5 years, and you have to be age 59 and a half. Those two things have to be true for the Roth IRA to be completely tax-free. When you're making Roth contributions, you have to have earned income. So you must be paying FICA tax you must have, that's for the 401k. For the Roth IRA, you have to have earned income. So basically you're paying FICA on contributions that you're making to a Roth IRA, and that could be W-2 income, it could be 1099. There are other income types that are allowed when you're making contributions, but basically all of that to say that it can't be passive income in order to qualify you to make a Roth contribution. And then when you're looking at your income limits, you want to make sure that you're within the income limits in order to contribute directly to a Roth IRA. When we look at that table, if you exceed those income limits, or if you're within a range, then you may be able to make a prorated amount, but if you exceed it, you're not going to be able to make your Roth contribution directly to a Roth IRA. So what do you do? This strategy, known as a backdoor Roth IRA, is when you establish a traditional IRA, or maybe you have an existing traditional IRA, and you make a contribution to that traditional IRA and immediately convert it to Roth. So we're basically taking the back door to get your contribution into the Roth IRA for that tax-free growth. And the modified adjusted gross income table is updated annually. So that's very important. So if you used the backdoor Roth strategy last year and you're like, okay, well, my income is less than it was last year, you still may want to check it because there are updates made to that table every year. And so it's important to take a look at it and talk to your CPA to make sure that you're using the correct strategy in order to make your contributions to the Roth. So again, the way that this is done is you establish a traditional IRA or utilize an existing IRA, traditional IRA, you make your contribution and then you convert it via Roth conversion to the Roth IRA, and now you have tax-free growth, and we'll talk more about that in just a moment. So here's the table. And I sort of did an abbreviated version of the table. So if you want to see the full table, I included the link below for you to check it out. But for 2023, remember this is 2023, if you're married filing jointly or a qualifying widow or widower, you can contribute to a Roth IRA directly if you have less than $218,000 in modified adjusted gross income. If you're between 218 and 228,000, you can contribute a prorated amount. And if you're above 228,000, you can't contribute directly to a Roth IRA. If you're married filing separate, less than 10,000, if you have less than 10,000, you can make a contribution to a Roth IRA. But if it's 10,000 or greater and you lived with your spouse at any time during the last year, you cannot contribute directly to a Roth IRA. And then you can see the limits here for single filing head of household or married filing separately. And there's a note there if you did not live with your spouse at any time during the year. So there's the limits there. If you make less than 138,000, you can make your full contribution to the Roth. If it's between 138 and 153, there's some prorated amount. And if it is 153 or greater, you cannot contribute directly to a Roth. So if you are within those income limits or above, so you can make a prorated contribution or no contribution at all, this next portion is for you. How do you get money into a Roth IRA if you're within or above those income limits? A contribution is very specifically an amount you add to a retirement account, subject again to the limits discussed, and they're separate from earnings. So this is money out of your pocket, out of your personal bank account, and into a retirement account. That is a contribution. We're not talking about earnings on your contributions once inside the account. So the first step is making your annual contribution. You're going to make it to a traditional IRA. So you might have to set up a traditional IRA, or if you have an existing traditional IRA, you can use that. The next step is going to be to do the Roth conversion. You're going to complete a form, make a request, depending on who your custodian is, to move that money to a Roth IRA. And then the third step for you is going to be checking with your CPA on any tax implications when you're doing this Roth conversion, because remember, a traditional IRA is a pre-tax account. So if you're moving from a pre-tax account to an after-tax account, you're going to pay taxes in order to do so. So keep that in mind. This is a taxable event. Now, how much you'll pay in taxes is certainly going to depend. There are some other things to take into account when you're doing Roth conversions. So the first thing is that when you're moving from a pre-tax to an after-tax account, this is a taxable event. There is going to be a 1099 generated for you to pay the taxes, and the IRA does not pay the taxes. That'll be the first question that I get. And so just for clarity, the IRA does not pay the taxes. It's not something that you can do withholding on. It is actually a tax burden to you in the form of that 1099. So we will issue you a 1099, and at the end of the year, you'll include it as ordinary income in order to pay the taxes. That 1099 will be a 1099-R issued again by your IRA custodian, and then you'll have your CPA assist you in paying the taxes on that additional income for the year. If you or your spouse are involved or participate in a 401k through your employer, and that actually also does include SEP IRAs and simple IRAs, so just make a note, SEPs and simples are included. So if you're participating in an employer plan, contributions to a traditional IRA may not be tax deductible. So again, there's a modified adjusted gross income table for that as well. And it's actually not the same table as the Roth contribution table I showed you above. So you will have to go to the IRS website and you can check it out there. If anybody would like the link to that, please send me an email separately after the webinar and I'll make sure to get it for you. But if you are participating in a plan, depending on how much participation you have and your modified adjusted gross income based on that table specifically, you may not have a deductible traditional IRA contribution. And so if that is true, your calculation on taxes paid are going to be different than how it would work if you're making your traditional IRA contribution without participating in an employer plan. And if you have any other traditional IRAs anywhere in existence, so for example, if you're a client of Advanta and you set up a new traditional IRA, make your contribution and you want to immediately convert it to Roth, even though the only monies in that traditional IRA are going to the Roth IRA for the conversion, it's going to be a prorated amount. The taxable amount is going to be prorated. And again, these are times when you definitely want to get your CPA involved so you can understand how the taxes will be paid or basically owed at the end of the year for this conversion. So I know that's a lot of information and I don't see any questions, but I want to give everybody just a minute to kind of take that in. And if you do have any questions, please feel free to type them into the chat box, because when we're talking about a backdoor Roth contribution, it seems like it would be simple enough, but of course there are going to be tax implications, and how you're taxed on that Roth conversion is going to depend on all of those factors that we talked about above. Something else to note is, although it can be fairly straightforward or maybe a little more complicated when you make the contribution and you pay the taxes on that Roth conversion, the great thing is that now you're going to enjoy tax-free growth as long as that conversion has aged for 5 years and you're age 59 and a half. So remember, at the very beginning of the webinar, I mentioned 2 things have to be true for the Roth IRA to be completely tax-free. It has to have aged for 5 years and you have to be age 59 and a half. The exception to that is each time you do a conversion, the Roth conversion has its own 5-year aging. So if you're going to do that Roth conversion, that backdoor Roth contribution every year and do a conversion, every year that you do that, you're going to have a new 5-year aging on the new amount converted. And so you're kind of keeping a table so that you know how much money has aged for 5 years, especially if you're over the age 59 and a half and you want to start taking distributions. The good news is that your distributions have a sort of an order of operations on distributions, and your contributions are always distributed first, followed by the oldest, and so on and so forth. And so again, you do have to keep track. It's something you can have your CPA assist you with, but the good news is once you do the conversion and it's aged for 5 years, you do have tax-free growth. So I had a few comments and questions pop up here. When doing a Roth conversion, if you have more than one IRA, how does the Form 5498 correctly report taxable income to be recognized? So again, it's actually reported on the 1099. The 5498 reports simply any contributions made, values, rollovers, and things of that nature, but the 1099 is going to report the taxable income. What if you contribute to a Roth IRA and you find out you're not allowed? Then you can simply do a recharacterization. Depending on when you take that corrective action, there may be a 6% penalty that applies for leaving the money in the Roth IRA, but you certainly can reach out to us and I can assist you with more information on that. But ultimately, your CPA is going to be the best person to assist you. And that does happen. We have people make a contribution to a Roth IRA and then they find out at the end of the year that they earned too much in that year. And so what do? They recharacterize that amount to a traditional IRA. So they have to take that corrective action. And then ultimately, in the end, you can go back and do a Roth conversion and get that money into the Roth IRA and have that 1099 generated in order to still have that tax-free growth. So the backdoor Roth contribution is only necessary if your income is above the limits, and that is correct. Yes, if your modified adjusted gross income is over those limits or within those limits, remember that there was a prorated contribution allowed, and then over the limit, no contribution allowed, then you can utilize that backdoor strategy to get 100% of the allowed contribution into a Roth IRA. So the next question is, if opening a backdoor Roth IRA, once you make the non-deductible contribution to a traditional, how long before you have to wait to convert it? You do not have to wait. You can do it, basically fill out all the forms all at once and make the conversion as soon as the cash is available in your IRA account. So for example, if you wire funds to your traditional IRA tomorrow, we can do the Roth conversion, and then that 1099-R would be generated at the end of the year. So something you would receive in January. Give me just a second to review the questions here. So the question is, how does the 1099-R correctly report taxable income? That is actually something you're going to work with on your with your CPA. If you have for example, a non-deductible IRA contribution made, and then you convert it to a Roth, how does the 1099 report the accurate amount to that is going to be considered taxable income? It's actually just going to show the converted amount and not the taxable amount. So it's definitely going to be something where your CPA comes into play here and helps you calculate the taxable amount so that you can correctly pay taxes on the amount. You know, if you do have a non-deductible, especially if you have a non-deductible contribution made to your traditional IRA. How do self-employed contribute to pre-tax traditional IRAs and then convert to a Roth? That's something actually you do have to have your CPA assist you with, especially if you don't take a regular paycheck. So if you're self-employed and you're wanting to make a contribution to a traditional IRA, but then ultimately down the line or convert it to a Roth, or you're going to utilize a backdoor Roth, I would talk to your CPA about that, because I know a lot of times when you're self-employed, you don't have a regular paycheck, so there's no tax withholding. And so you might be, you know, quarterly looking at paying yourself, for example, paying your taxes and taking a check yourself. And that, again, is something that I would feel most comfortable with having your CPA assist you with. And why traditional IRA contributions unlimited? They're not unlimited. They're still going to be limited to $6,500, but they typically don't have an income limit. So you can always contribute to a traditional IRA as long as you have earned income, but if your income limit is above a certain amount and you're fully participating in an employer plan, it may be non-deductible. So I just wanted to clarify there. You can always contribute to a Roth IRA, but there's a limit. It's $6,500 or $7,500 if you're over the age of 50. And then it may or may not be deductible depending on your income and whether or not you participate in an employer plan. Are income limits based on the prior year's modified adjusted gross income? No, they're based on the year you plan on contributing. So I hope that clears everything up. I don't see any more questions on this topic, but I will continue to take them on Backdoor Roths as we go through and talk about the 401k and the Mega Roth contribution to the 401k as well. Now, keep in mind again that the Secure Act did change the opportunity for people to make contributions as their own employer directly to the Roth portion of the 401k. However, the plan must be updated to accept those contributions, and we're also still waiting on some clarity from the IRS for those contributions. And as we kind of get more information, I'm sure we'll do webinars that will help people understand those contributions and how to make them going forward. The solo 401k has a lot of benefits. There's higher funding limits, as we talked about, $22,500 for 2023, or $30,000 if you're over the age of 50, $66,000 combined total, or $73,500 if you're over the age of 50. And so you have a lot of opportunity to really sort of lump fund a plan if you are considered self-employed. So 1099 income, some Schedule C, some K1, W2 if you have your payroll set up. Basically anything you're paying FICA or self-employment tax on, and you are eligible for the solo 401k. If you are self-employed, you are an equitable owner in the business, and any spouses in those, as long as you have no employees. So spouses are allowed, and you can include your spouse in a solo 401k, but no other employees can be included, and that includes children. And that's important because a lot of times people see that spouses are allowed to be included, so they assume that children can be included too, but that is just simply not the case. They would have to be an equitable owner in the company, or a partner essentially, in order to qualify and allow you to qualify for a solo 401k. I had a question pop up. Can an LLC inside of a self-directed IRA have a Roth IRA? Roth IRAs are for individuals, so I'm not sure if I'm answering your question correctly, but I'll clarify. Roth IRAs are for individuals, not for entities. And so your ability to contribute to a Roth IRA is based on you being an individual, and that contribution would go into the Roth, and then the Roth could ultimately own an LLC, something we call checkbook control. So the LLC could be owned by a Roth IRA and in turn make investments for tax-free growth. So again, higher funding limits, and we talked about what that is. You can defer both employee contributions and a third type of contribution called an employee after-tax non-Roth contribution. And that third type of contribution is going to come into play here when we're talking about making Mega Roth contributions to your 401k. The 401k allows rollover opportunities, and what that means very simply is that you can take money from an old employer plan or a pre-tax IRA and roll it into your 401k. The 401k plan does again have to allow for these types of contributions. So it has to allow for rollovers, it has to allow for all three types of contributions, and they don't all. So if you're not with Advanta for your solo 401k, make sure that your plan allows these opportunities for you. It's important that the plan allows them. You have access to tax-free loans. You can escape unrelated business income tax for debt leveraged real estate. UBIT does still apply in some circumstances, but not when you're purchasing real estate with debt. Cost-effective administration, a solo 401k is very cost-effective compared to a larger plan. And again, the Roth 401k. So having the opportunity to make contributions for tax-free growth. And when you're utilizing all three of these contributions, you can really put a lot of Roth money into the 401k. A lot of times people use this term Roth 401k thinking that 100% of the contributions are automatically Roth, and that is simply not the case. Again, going forward, we're probably going to see more people utilizing and having plans that allow employer contributions that are Roth, but currently you're probably not going to see a ton, and again, we're waiting for more clarification. So currently, people are typically making contributions as the employer pre-tax. That would be very typical, and up until 2023, that was the only way an employer could make a contribution, would be pre-tax. If your 401k allows Roth contributions like Advanta's 401k does, then the employee contribution could be Roth. It could be designated as Roth. And I don't like to say after tax, and you're going to see why in just a moment. But it could be a Roth contribution. And I'm sorry, that is the 2023 contribution limit. I forgot to change the year, but I updated the amount. So for 2023, it's $22,500 as the employee. Employee contributions can be Roth, they can be traditional, or any combination of the two. So as the person making the contribution, you get to choose. And this year might be the year that you want a deduction on your taxes. And so you might say, I'm going to make my employee contribution as traditional. You might say, you know what, from now on, I want tax-free growth, so I'm going to make it as Roth. Or you might say, I want to do a combination of the two, so I have some tax-free growth and I get a deduction for making a contribution as well. The annual limit for employee contribution is much higher than a Roth IRA contribution, and there are no income limits on your Roth 401k contribution. So remember that whole table, that whole discussion, the whole reason behind the Backdoor Roth IRA is because there are income limits. There are no income limits when you're making a contribution to a Roth 401k. So if you had $22,500 in earnings for 2023, you could potentially get that all into a Roth 401k, and just, you know, making sure that, again, that you check with your CPA to make sure you can make the full contribution. But you have the opportunity to make that contribution as Roth as long as your plan would allow it. So here is information on how to make your contribution and get it 100% tax-free. So $66,000 is the contribution limit for 2023. It's $73,500 if you're over the age of 50. The first contribution is the employer contribution. And again, we're going to talk pre-tax right now, but in the future, we're probably going to see more contributions from the employer being made as Roth. The employer contribution can be 20 to 25% of the earned income. That variation is going to depend on how you file, how your business is set up and files, and how you pay yourself. So if you're a sole proprietor, it's probably going to be on the lower end. If you're an S Corp, for example, you're probably going to be on the higher end of that 25%. Again, checking with your CPA. The next contribution is the employee contribution. So $22,500 for 2023, or $30,000 if you're over the age of 50. This contribution can be Roth or traditional, but we're going to talk Roth because that's what we're talking about today. And then the third type of contribution is an employee contribution. It's considered after tax non-Roth, and that's very important because it does not automatically grow tax-free. You have to do a Roth conversion, even if it's just paperwork, to show that it is going to grow tax-free. If you make this third type of contribution and you do not take the extra step to do the Roth conversion, it's going to grow tax deferred. So you have to keep track of the amount you already paid tax on, and then you'll have tax deferred growth on it in the future. So how does this all work? Well, here's an example for you. John is a sole proprietor who has 2023 salary is whose 2023 salary is $100,000. And he's going to make his employer contribution. Remember, I said sole proprietors are probably going to be on the lower end, closer to 20% for the employer contribution. So $20,000. The employee contribution is $22,500, and he can make that full contribution for this year. And then he has an employee after-tax non-Roth contribution, because his plan allows it, of $23,500, and his total contribution is going to be at the limit of $66,000 because he is utilizing all three types of contributions here. Your contributions are based on your business's earnings, your earned income from the business, and how you file for your business. And the best person, again, to help you calculate these contributions is your tax professional. And you guys, I know a lot of times people reach out to me and say, well, what would it be? What would it be? But your tax professional really has the overview of all of these things, all of these elements that come into the calculation. And so we really cannot help you make this contribution. The best we can do is tell you what the limits are for each, and then give you that information so that your CPA can assist you. So how did we get this $23,500 number? Well, here's the calculation for you. The calculation to reach the total annual limit is going to be the employer contribution plus the employee contribution subtracted from the annual limit. So you take, we'll go back here, you take the employee contribution and the employer contribution and you combine them, and then you subtract them from the annual limit, and that's how you get the employee after-tax non-Roth contribution. Remember that it's considered non-Roth, so you must take the extra step to convert it to Roth. And all of these elements must be things that your plan allows. Your plan must allow Roth contributions. It must allow employee after-tax non-Roth contributions, and it must allow in-plan Roth conversions. Another way to do that would be to take a distribution of the after-tax portion directly to a Roth IRA for tax-free growth. But if you're going to do that, your plan must allow in-plan in-service distribution. So a lot of elements that your plan must allow in order to incorporate this strategy. So after-tax non-Roth contributions are tax deferred, not tax-free, unless you take that extra step. There's the calculation for you again. As long as your plan allows it, you can immediately convert those monies to Roth so that they do grow tax-free. You must have the amount in earned income. So sometimes people will tell me, well, I had $30,000 in earned income. Can I contribute the $66,000 to the plan? The answer is no. So check with your CPA if you need help understanding how to have earned income or what qualifies you to make the maximum contribution in the plan. So making your Mega Roth contribution. Step one, calculate your after-tax non-Roth contribution and of course your employee and employer contribution. Make the contribution to the plan and convert this amount to the Roth component of your plan. Or distribute, again, we talked about that. Your plan must allow in-service distributions, and then checking with your CPA on the tax implications. And again, keeping in mind that the tax implications are going to be conversions and probably a personal tax burden, but again, checking with your CPA to make sure you understand how taxes will be paid for these Roth conversions. A lot of times you have to have a triggering event in your 401k to allow you to distribute funds from your 401k, and these events vary from plan to plan. So again, I know this is a lot of information. So if you have any questions on that strategy, I'm gonna kind of give you the opportunity to get those questions typed into the chat box because I didn't see any questions pop up. But keeping in mind, so a lot of times people will say, well, if I make that Roth contribution to my 401k, so $22,500 for 2023 or $30,000 if you're over the age of 50, then I can't have a Roth IRA. And actually that isn't true. You can actually have both, and you can utilize both of these strategies if you're self-employed. So if you're self-employed and you want to have a solo 401k and you want to make your Roth contributions and your employee non-Roth after-tax contributions plus your employer contributions and still have a traditional IRA, which you will immediately convert to a Roth, you certainly can do all of those things. Again, just checking with your CPA and making sure that you have plenty in earned income this year in order to make all of these contributions. And a question popped up, what are the limits for the 401k again for over the age of, it's actually over the age of 50, and it's 22,500 for those under 50. You get another 7,500 over the age of 50, so 30,000 would be the employee contribution, and then that grand total employee and employer are 73,500 for those over the age of 50. I had a question pop up on the rules for a spouse contributing to a Roth 401k. So who is eligible for a solo 401k? It's going to be the business owner and their spouse, and both the business owner and the spouse have to be paid from the business in order to be eligible to contribute to the solo 401k. So I want to make that clear too, because sometimes people will say, well, they don't have an income from the business, so what is their potential for a contribution? And they have to have earnings from the business in order to make a contribution to the plan. And their contribution is going to be limited based on their earnings, and that's the same for the business owner. So that's a good point to make, is if you only had 10,000 in earnings as a self-employed individual this year, then you're only going to be eligible to up to 10,000 in contribution limits. And then also checking with your CPA to make sure the business earned enough to make the full contribution. I had another question pop up here. A question about still making contributions for 2022. So your employer contribution is still allowed for 2022. So if you didn't make an employer contribution for a solo 401k, you can still do that up until your business filing plus extensions. So that's very important, business filing plus extensions. I had another question pop up as to whether employee bonuses count towards earned income. That's a great question. I am going to defer to your CPA, but I am also going to say that if the bonuses have that FICA tax attached to it, if they're paying that FICA on the bonuses, then it potentially, but again, checking with your CPA on that. So just to reiterate, you can contribute you can use both strategies of Backdoor Roth IRA as well as the Mega Roth 401k. In some cases, you may not be able to contribute directly to the Roth IRA, again, based on your modified adjusted gross income, and those tables adjust annually, as well as the non-deductible traditional IRA tables. So check them every year. If you're utilizing the strategy one year, it's very likely that you'll have to use it year after year, but you want to know what the modified adjusted gross income requirements are based on those tables, and you can find them right on the IRA website. Check with your CPA to find out if your traditional IRA will be deductible, and then how that deductibility will affect making a contribution to a traditional and then converting it to Roth. So a couple of notes there on making those contributions in the taxation. We have classes all the time, and actually before I go into that, I just want to give everybody the reminder and opportunity to type any questions into the chat box before we end the session, and also to download the handouts. If you check the navigation for the webinar, you're going to see a handout category, and I did upload the slides as handouts so you can download those. If you would like them, if you have any trouble downloading the slides, please feel free to send me an email and I'll make sure you get the slides for review. I had a question, can I email you? Questions? Absolutely. If you have something more specific that you would like to get answers on, please feel free to email me. I had another question pop up. To make a non-deductible 401k contribution, where does the total overall limit come from if the employer is making a full contribution and the employee is making a full contribution? So it's still going to be $66,000. So if your income, let's say your income is $1 million a year, then $66,000 is absolutely the max you can make. So if your 20% plus your $22,500 gets you to that $66,000, then you're going to have maxed out that plan and you can't contribute using the non-deductible contribution because you have already maxed it out. So just keeping in mind that that overall limit is overall regardless of your earnings. And we have events all the time, and if anybody has additional questions on things allowed within a self-directed retirement account, solo 401ks, plans for small business owners, and actually we have a webinar coming up on plans for small business owners where my associate Alex is actually going to be talking about SEPs, simples, and solo 401ks and the benefits to each and kind of how they differ. And so if you're looking to learn more about how to contribute as a small business owner, then please feel free to check out advantaira.com/events for that upcoming webinar. It's just a couple of weeks away. We also have our video library where everything gets archived, including this webinar. So if you want to check it out again, you're certainly going to get an email with the recording. But if you wanted to check out more webinars, you can check out our video library or go to YouTube and search Advanta IRA, where we also archive all of our webinars. And you can check out our blog. I know you guys might be on our mailing list if you've registered for this webinar. So if you are, you're going to get updates from our blog, where we keep up with the latest industry news, updates, and insights. And again, keeping your eye on that for more updates from the Secure Act 2.0, because I think that'll be important going forward. I had another question pop up on income. So if there's not enough income to reach the maximum, is that when you would use the non-Roth after-tax contribution? That's correct. That's typically where you're going to see people using that third type of contribution. If, again, looking back at my example, if you had 100,000 in earnings this year, that's not going to get you to 66,000 based on that formula of 20 to 25% of your income plus 22,500. And so that's where you would probably use that third contribution in order to get you to that 66,000, just like in my example. Again, my contact information is here on the screen for you, and so please feel free to reach out to me if you have more personal or more specific questions for me. You can send me an email or reach me directly with that extension. I'm happy to answer your questions. This webinar has been recorded and will be sent out for your review and for you to share if you would like. We hope that you'll join us for more information on our educational webinars, and they're going on several times a week, and we also have our own networking opportunities. So please check out advantaira.com/events for anything upcoming that we have, and we hope to see you again soon. Thank you, guys.